Lesson 1. Basics of Derivatives. Hello everyone, and welcome to the first lesson of Mastering Futures and Options Trading, a comprehensive course. Today, we'll be diving into the basics of derivatives. Grasping what derivatives are and how they operate is essential for understanding more advanced trading concepts. To start, let's use a simple analogy to clarify this concept. 1. What are derivatives? Let's begin by exploring what derivatives are through a simple analogy. Think of derivatives in everyday life. For instance, paneer is derived from milk. Here, milk is the underlying asset, and paneer is the derivative. Similarly, financial derivatives are instruments whose value is derived from an underlying asset. Now that we have a basic analogy, let's move on to a more formal definition. Derivatives are financial contracts whose value depends on the price of an underlying asset. This underlying asset can be anything like stocks, indices, gold, silver, or even agricultural commodities. To make this clearer, let's consider an example. If you have a gold futures contract, its value is derived from the price of gold. The contract itself does not have any intrinsic value, but gains value based on the fluctuations in gold prices. Great! Now let's highlight some key points to remember about derivatives. Derivatives derive their value from underlying assets. Common underlying assets include stocks, bonds, currency, market indices, commodities, and interest rates. With that understanding, let's move on to discuss the various types of derivatives. First, let's look at futures contracts. A futures contract is a standardized agreement between two parties to buy or sell an asset at a predetermined price on a specified future date. These contracts are traded on exchanges and can be used for hedging or speculative purposes. Example: imagine an investor believes the price of silver will rise. They enter into a futures contract on the multi-commodity exchange to buy 30 kilograms of silver at 70,000 rupees per kilogram 3 months from now. Each silver contract is of 30 kilogram means. When you enter into a silver contract, you are agreeing to sell 30 kilogram silver on an agreed future date. Scenario 1. If the price of silver increases to 75,000 rupees per kilogram at the contract's expiry, the investor profits 5,000 rupees per kilogram. Total profit: 30 kilograms into 5,000 rupees per kilogram equal to 1,50,000 rupees. Scenario 2. If the price of silver falls to 65,000 rupees per kilogram at the contract's expiry, the investor incurs a loss of 5,000 rupees per kilogram. Total loss: 30 kilograms into 5,000 rupees per kilogram equal to 1,50,000 rupees. Next, let's talk about options. An option contract is a financial derivative that gives the holder the right, but not the obligation, to buy, call option or sell, put option, an underlying asset at a predetermined price within a specified time frame. The buyer pays a premium for this right. We will discuss options in more detail in future chapters. Now let's move on to swaps. Swaps. A swap is a derivative contract where two parties exchange cash flows or other financial instruments over a specified period. The most common swaps are interest rate swaps, currency swaps, and commodity swaps. These contracts are used to manage risk, hedge against fluctuations, or speculate on price movements. Example: imagine two companies, Company A and Company B. Company A has a loan with a fixed interest rate, while Company B has a loan with a floating interest rate. They agree to an interest rate swap where Company A will pay Company B's floating interest rate and Company B will pay Company A's fixed interest rate. This allows both companies to manage their interest rate exposure more effectively. Lastly, let's discuss forward contracts. A forward contract is a customized agreement between two parties to buy or sell an asset at a specified price on a future date. Unlike futures contracts, forward contracts are not standardized or traded on exchanges, and they can be tailored to the specific needs of the parties involved. Example: imagine a shopkeeper and a wholesaler. The shopkeeper agrees to buy 10,000 kilograms of sugar from the wholesaler at 40 rupees per kilogram, with delivery in 3 months. The shopkeeper is expecting the price to go up. Scenario 1. Price increase. If the market price of sugar rises to 50 rupees per kilogram after 3 months, the shopkeeper still buys at 40 rupees per kilogram, potentially saving 10 rupees per kilogram. Total savings: 10,000 kilograms into 10 rupees per kilogram equal to 1 lakh rupees. Scenario 2. Price decrease. If the market price of sugar falls to 30 rupees per kilogram after 3 months, the shopkeeper still buys at 40 rupees per kilogram, potentially incurring a higher cost of 10 rupees per kilogram. Total extra cost: 10,000 kilograms into 10 rupees per kilogram equal to 1 lakh rupees. Now that we have a good grasp of the types of derivatives, let's move on to some key terminology used in this field. Underlying asset: the financial asset from which a derivative derives its value. Examples include stocks, bonds, commodities, currencies, interest rates, and market indices. Example: for a gold futures contract, gold is the underlying asset. Strike price: the price at which an option holder can buy or sell the underlying asset. Example: in a Nifty call option with a strike price of 18,000, 18,000 is the strike price. Premium: the price paid by the buyer to the seller for an options contract. It represents the cost of acquiring the right, but not the obligation, to exercise the option. Example: if the premium for an option is 5 rupees per share and the contract is for 100 shares, the total premium paid is 500 rupees. Expiration date: the date on which a derivative contract expires. Example: Nifty futures contract expires on the last Thursday of the month. That's the expiration date for Nifty monthly contracts. Having covered the key terminology, let's now discuss the benefits and risks of trading derivatives. Benefits and risks of trading derivatives. Benefits: leverage. You can control large positions with a relatively small amount of capital. Hedging. Derivatives can be used to hedge against potential losses in other investments. Speculation. Traders can profit from the price movements of underlying assets without owning them. Risks. Leverage risk. While leverage can amplify gains, it can also amplify losses. Market risk. The value of derivatives is influenced by the price movements of underlying assets, which can be unpredictable. Complexity. Derivatives can be complex instruments that require a deep understanding to trade effectively. Liquidity risk. Some derivatives may lack liquidity, making it difficult to enter or exit positions at desired prices. Regulatory risk. Changes in regulations or legal frameworks governing derivatives can impact their trading and market conditions. Conclusion. In today's lesson, we explored the basics of derivatives, including their definition, types, key terminology, and practical examples. We also discussed the benefits and risks associated with trading derivatives. Understanding these fundamentals is essential as we move forward in our course. In the next lesson, we'll dive deeper into futures contracts, their structure, and how they are traded. Thank you for joining today's session.